Imagine waking up tomorrow morning and seeing a notification on your phone. Breaking news alerts are everywhere. Your phone keeps vibrating, television channels switch to emergency coverage, and every social media platform is filled with the same terrifying headline. Global tensions have exploded, military forces are mobilizing, and experts are warning that a large-scale international conflict could begin at any moment. Within minutes, financial markets begin reacting. Stocks start falling rapidly, oil prices surge, gold spikes higher, and analysts begin predicting chaos. The atmosphere feels tense and uncertain. In that exact moment, millions of investors around the world do the same thing. They open their investing apps, look at the red numbers on their screens, and begin selling their investments as fast as possible. Fear takes control. Panic spreads through the markets faster than any news headline. But here is the strange thing that most people do not realize. When you study financial history, you discover that wars have rarely destroyed long-term investors. In fact, many investors who stayed calm during global conflicts ended up building enormous wealth over time. The real damage is usually caused by panic selling. When investors sell everything during moments of fear, they lock in their losses and often miss the powerful recoveries that follow. Markets are emotional in the short term, but over long periods of time they are driven by economic productivity, innovation, and government spending. And during wars, government spending reaches levels that are almost unimaginable. Countries begin investing enormous amounts of money into weapons manufacturing, transportation systems, cybersecurity, satellite technology, medical supplies, fuel production, communication infrastructure, and defense equipment. Billions, and sometimes trillions, of dollars begin flowing through the economy. That money eventually reaches companies that produce these goods and services. These companies generate revenue, that revenue turns into profits, and those profits influence stock prices. History shows this pattern again and again. Before wars officially begin, markets often fall because uncertainty makes investors nervous. No one likes uncertainty. But once the conflict begins and governments start mobilizing their economic resources, markets frequently stabilize and eventually recover. For example, during World War II, the U.S. stock market experienced volatility at the beginning of the conflict, but over the course of the war, the market actually produced positive returns. Similar patterns occurred during the Korean War and the Gulf War. Initial fear triggered market drops, but as the economic effects of wartime production spread through industries, markets began recovering. This creates one of the biggest psychological traps for investors. When markets are falling and every news headline predicts disaster, selling everything feels like the responsible choice. It feels safe. It feels logical. But research consistently shows that panic selling is one of the most damaging financial decisions investors can make. Some of the biggest single-day gains in stock market history have happened immediately after major crashes. Investors who sell during panic often miss these powerful rebounds. Studies have shown that if an investor misses just a handful of the best trading days in the market, their long-term returns can drop dramatically. Over a period of 20 years, missing the 10 best days in the market can reduce investment returns by more than half. And the most surprising part is that many of those best days occur within days of the worst market drops. This means the investors who panic and leave the market are often locking themselves out of the recovery. So if a global conflict were to begin tomorrow, what would experienced investors actually do? They would not panic. Instead, they would follow a structured strategy designed to protect their wealth while still allowing their investments to grow over time. The first step in that strategy is financial stability. Smart investors always make sure they have a strong emergency fund before making aggressive investments. This usually means keeping 6 to 12 months of living expenses in a safe and accessible place such as a savings account. This money is not meant to produce high returns. Its purpose is security. When investors know their basic expenses are covered for several months, they are far less likely to make emotional decisions during market turbulence. Some investors also keep a small amount of physical cash available. This is not about expecting a collapse of the financial system. It is simply a precaution. During geopolitical crises, there can sometimes be temporary disruptions in digital banking networks or payment systems. Having access to cash for basic purchases during short disruptions can provide additional peace of mind. Once that safety layer is established, investors often think about diversification. Diversification simply means spreading investments across different types of assets so that one single event cannot destroy an entire portfolio. One of the oldest assets used for diversification during uncertain times is gold. For thousands of years, gold has been viewed as a store of value. When currencies weaken or inflation rises, gold often maintains its purchasing power better than paper money. This is why many experienced investors allocate a small portion of their portfolio to gold or precious metals. However, professional investors rarely place the majority of their wealth into gold. Instead, they treat it as a stabilizing asset. Typically, gold might represent 10 to 15% of a diversified portfolio. Its purpose is to balance risk, not to replace long-term investments like stocks. Another sector that often becomes important during geopolitical tension is defense. When countries prepare for or engage in military conflict, defense budgets expand rapidly. Governments begin ordering aircraft, advanced technology systems, cybersecurity solutions, surveillance equipment, and various military tools. Companies that manufacture these products often experience increased demand because governments become their largest customers. Over the past several decades, many defense companies have experienced strong growth as global military spending continued rising. Even outside of wartime, countries invest heavily in national security, which means this sector often receives consistent funding regardless of economic cycles. Energy is another industry that frequently plays a major role during conflicts. Wars can disrupt oil supply routes, shipping lanes, and energy infrastructure. When energy supply becomes uncertain, prices often increase dramatically. Higher oil and gas prices can lead to strong profits for companies involved in energy production and distribution. Because modern economies rely heavily on energy, demand for oil, natural gas, and electricity rarely disappears even during global crises. Another category investors often consider during uncertain times is consumer staples. These are companies that produce everyday essential products like food, beverages, cleaning supplies, hygiene products, and medicine. Even during severe economic downturns or wars, people still need basic necessities. Demand for these products remains relatively stable, which means companies in this sector often experience less volatility compared to industries like luxury goods or speculative technology. In addition to these sectors, investors sometimes think about assets that provide protection against inflation. Wars are extremely expensive, and governments often finance them through borrowing or money creation. This can increase inflation over time. When inflation rises, the purchasing power of cash slowly declines. Certain investments are designed specifically to adjust with inflation and help protect wealth during periods of rising prices. But despite all these strategies, the most important rule of crisis investing remains surprisingly simple. Do not abandon long-term investments out of fear. Diversified index funds and long-term portfolios have survived world wars, economic depressions, political crises, and global pandemics. Over time, the global economy has continued expanding, driven by innovation, population growth, and technological progress. The investors who succeed over decades are usually not the ones who perfectly predict global events. Instead, they are the ones who remain disciplined when everyone else becomes emotional. When markets fall, disciplined investors continue investing consistently. Sometimes they even increase their investments because lower prices create better long-term opportunities. Instead of viewing crises as reasons to panic, they view them as temporary disruptions in a much longer economic story. Markets may fall dramatically during short periods, but history shows that they often recover and continue growing over time. So if a major global conflict ever begins tomorrow, two different types of investors will appear. One group will panic immediately. They will sell everything, move their money into cash, and wait months or even years for the world to feel safe again. The other group will stay calm. They will review their strategy, maintain diversification, and continue investing patiently. Years later, when markets recover and economies stabilize, the difference between these two groups becomes clear. The investors who stayed disciplined often emerge stronger, while those who reacted emotionally spend years trying to catch up. History has shown this pattern repeatedly across generations. Markets experience crises, investors panic, and then the economy eventually adapts and continues moving forward. The real question is not whether another crisis will happen in the future. History suggests that it almost certainly will. The real question is how investors will respond when it does. Will they follow fear, or will they follow strategy? Because in the world of investing, the people who build the most wealth are rarely the ones who predict every crisis perfectly. They are the ones who remain calm, patient, and disciplined when the rest of the world is losing control. And when the next major crisis arrives, that single difference in behavior can change an investor's financial future forever.